Hey everybody, welcome back to Investing with Wesley. In my previous video up here, I talked to you about the prime rate. And I talked to you about that because a lot of people don't know what the different rates are and how they affect you. So I'm going to expand on that a little bit today. And today I'm going to talk to you about the LIBOR rate because believe it or not, it's a very important rate that affects you in more ways than one. So let's get into it. So the LIBOR rate stands for the London Interbank Offered Rate. Now, just reading the full name of the LIBOR rate, you might be able to deduce what this rate is. The LIBOR rate is the rate that global banks use to lend money to each other. It is the Interbank Offered Rate, LIBOR rate, and it is incredibly similar to the federal funds rate. If you remember from the previous video where I talked to you about the prime rate and how it is closely tied to the federal funds rate, the federal funds rate is the rate that U.S. banks lend their excess reserves to other U.S. banks overnight. The LIBOR rate is extremely similar to that, except that it's global. Now, the LIBOR rate is calculated every day similar to the prime rate, except that the LIBOR rate is calculated not by the Wall Street Journal, but by the British Bankers Association. The BBA will call various global banks and ask them at what interest rate they would charge to lend money to a bank in a different country. So they'll call a US bank asking what rate they'll lend to a bank in Ireland. They'll call an Irish bank and ask at what rate they would lend to a bank in Japan. And they do this hundreds of times every day. And what they do is they take the largest and the smallest rates that they're given and remove those from the group of rates. And then they average out the remaining rates that they're given. And this gives the LIBOR rate. Now, truth be told, I didn't really learn exactly how the LIBOR rate was calculated up until about a year and a half ago. And when I learned how the LIBOR rate was calculated, I was dumbfounded at the amount of fraud potential that lays buried within the LIBOR rate. If this rate is calculated by the BBA calling various banks and just asking them what rate they would lend to and then averaging it out, what's stopping all the other banks from contacting each other and saying, hey, we need it to be about 2%, or hey, economy is looking good globally, let's bump it up to about 5%. There is nothing that says they can't do that because it is literally just someone on the phone calling other bank managers and asking them one question and then averaging all that together. There's so much fraud that could have happened with the LIBOR rate that it is ridiculous. And it is amazing that very important things that affect our lending capabilities are tied to the LIBOR rate. Now, aside from the fraud aspect of things, why should you care about the LIBOR rate? If it's very similar to the federal funds rate that doesn't really affect our lending capabilities, why would the LIBOR rate affect our lending capabilities? Well, even in America where we have something like the prime rate, many commercial banks still use the LIBOR rate as a preferred benchmark when calculating the interest rate that they're going to charge its customers. Now, I will say that the LIBOR rate is more often used for variable type interest products as opposed to fixed type interest products. So as an example, if you were to buy a home with a 15 or 30-year fixed mortgage, chances are your lender is going to be using the prime rate. But if it's an adjustable rate mortgage or a home equity line of credit, a credit card, anything that has a varying interest rate, then chances are it'll be tied to the LIBOR rate. And as you would expect with a variable interest type account, as the LIBOR rate goes up, so will the interest you pay. As the LIBOR rate goes down, so will the interest you pay. Now, although it's most common for banks to use the LIBOR rate when it comes to variable type of accounts, it is not set in stone. Just like some variable type accounts like credit cards will still use the prime rate, some fixed accounts will still use the LIBOR rate. It's really interchangeable, and whenever you talk to a lender, for any reason, you need to ask them what benchmark they use, whether it's prime rate or the LIBOR rate, or anything in between. Now, considering there was a huge potential for banks to commit fraud with this rate and game the system in a sense, it amazes me just how much this LIBOR rate is tied to. The LIBOR rate, just like the prime rate, is tied to very important things that we use when we borrow money. It's tied to auto loans, it's tied to personal loans, it's tied to student loans, mortgages, you name it. So imagine if all the banks got together and said that they wanted to increase the LIBOR rate by 3 points, which has never happened and is completely crazy. But let's just say they did. Let's just say the LIBOR rate went from 3% to 6% overnight. That means all the interest rates that weren't at a fixed rate would go up that much overnight. And when you start tacking on the LIBOR rate to things like student loans and mortgages, which as a country we are completely over leveraged by, then if the LIBOR rate ever skyrocketed, we would all be screwed if you didn't have a fixed interest rate. And not only that, but there is an investment product out there that banks sell called a CDO, and that is a collateralized debt obligation. And typically what this is a bunch of mortgages put together, usually in a package of about 1,000. and then they sell this CDO to investors so that they can collect interest off of it. Now, I'll go deeper down that rabbit hole a little later, but one of the main things that caused the housing market crash in 2008 was junk CDOs. So the fact that the LIBOR rate could be manipulated and is tied into current CDOs, meaning at any point if there was fraud going on and the interest rates just started rising all of a sudden, even though the economy didn't warrant it, anyone that has a variable mortgage connected to the LIBOR rate would start to see their interest rate climbing as well. And there's a potential for another 2008-like crash to happen. I just scared you into thinking that there's going to be another 2008-like crash of the housing market. And maybe you're financially ready to swoop up on some deals, or maybe you are petrified because you just bought a house and you're afraid the value is going to be cut in half overnight. None of that will happen recently. At least I don't think it will. But I should tell you that the LIBOR rate is really no longer a thing. People found out that there could be the potential for fraud because the LIBOR rate wasn't connected to anything hard pressed, and that it was just calculated by a bunch of different phone calls. People found out, and they found out exactly what kind of commercial loans were tacked onto the LIBOR rate, and people got scared. So they decided to do away with the LIBOR rate starting January of this year, January of 2021. Now there's a phase out process and a phase in process, and it's not like a boom, pull the plug. But starting January of 2021, we will be phasing out of using the LIBOR rate, and instead they have introduced what's called the SOFR rate, SOFR. And by December of 2021, the BBA will stop reporting the current prime rate, meaning any new loans that people try and generate that are tied to the prime rate won't be accessible anymore. And instead, they will start producing the SOFR rate. Now, as far as the SOFR rate goes, everything will remain the same. The SOFR rate will still be connected to CDOs, student loans, mortgages, all that kind of thing. It'll just be a new way of calculating it to avoid the high potential for fraud. I encourage you to research the SOFR rate yourself, but if you don't feel like researching it yourself and just want to wait for the next episode, stay tuned because that's exactly what I'm going to be talking about in the next episode. I hope you got value from this video, and I hope I helped educate you on what exactly the LIBOR rate is and how it affects you. If you did get value from this video, please remember to like and subscribe because it really helps the YouTube algorithm in getting this channel out there so I can help and educate more people. Until our next video, have a good one.